I'd like to just approach this sort of in a before all this occurred and what brought us up to this point, and then currently, what are we doing, and then the going forward. Just the before, very simply, back home where I'm from, and I think around the country, people are upset, they're anxious, they're frustrated, they know a lot of money went out, and they don't see it translating into bank loans to them or frustrating dealing with lending capacity. And I think that's something, I want to spend a minute on that. The current, of course, relates to the what do we do right now? What can we do to get the economy going? And we all understand it is about liquidity. If we think about the RTC a number of years ago, ultimately we got through that because there was access to capital. And whether a building was worth $1 million and sold for $500,000, there was a market at some free enterprise point, buyer and seller, and they came through that. On a going forward basis, a lot of the discussion today, and we do appreciate your recommendations on what's being proposed. Mr. Frank has a number of suggestions which I think are worth considering, but we'll have those continuing discussions over the next few weeks. But what I want to focus on for a few minutes is just an echo of what you've heard all day today. And that is, I'm from Florida. Ms. Baer, you've heard my comments before on this, and I appreciate the opportunity to state it again. That is the access to capital, the strictness and the rigidity, if you will, the inflexibility of banks dealing with existing loans and, defaults based on covenants. I had someone come in my office today. He even said I could use his name, Wayne Cotton from Design Flooring Distributors in Fort Lauderdale. He had a little over $1 million line of credit, steady as you go for all these years. He's a leader in the community on a lot of levels. He's got buildings to back up everything else. And because his receivables are down, and he's in the building business, if you will, he does interior work, the bank said, we're calling the loan. He got a letter that said, pay up. Here's the date you have to pay up. And that's it. It's one of our major banks, a bank that took TARP money. And he is frustrated as all get out, as you can only imagine. And to me, the question is this. Why is it that some of these concepts of borrower capacity, the individual borrower, personal guarantee, whatever it may be, the idea of substitute collateral, being able to put other collateral in place, so maybe his receivables and that commitment is down, but maybe the loan can stay in place if there's some type of substitute collateral that can be applied. Why not the principle, and it's not tangible, but the principle of time heals. Over time, particularly in real estate, some of this will return to some point. We are not getting the banks to consider many of these principles at all. A little bit of sitting down with common sense across the table and saying, all right, you got a problem here, your collateral base is down, but maybe if you put another piece of real estate in here that has this amount of equity in it, we can still make this work instead of us calling the loan, and there's no ability to refinance, no ability to find another loan. So can you just share with me those 2 or 3 principles? Why is it that can't be integrated or introduced, and the examiners consider that or encourage that kind of behavior with the banks? Start out with Ms. Baer, if you don't mind.
We do encourage our banks to work with their individual borrowers and provide flexibilities and these individual credit determinations. I don't know the specifics of this circumstance, obviously, but we do encourage them to work with their borrowers. This is a very difficult judgment, though, for both banks and examiners to be making, because on the other hand, we get criticism, well, we can't let the banks, indefinitely defer loss, or if the loan's going bad, recognize it now, not later. So there are those countervailing pressures, and there are critics on the other side as well. So it's a very difficult balance, but we have a very clear policy. We've said this numerous times to our examiners, to our banks. We want them to work with their borrowers, their commercial borrowers as well as their residential borrowers. Even if they have some credit distress, try to restructure the loan, provide some relief rather than just foreclosing or cutting off. Where that makes sense from a loss mitigation standpoint, it needs to be appropriately disclosed and reported. But we absolutely encourage them to work with those borrowers and show flexibility.
And I can't tell you enough how that is not in any meaningful sense translating into the local, in Florida, where I'm from. I can just speak from my local market in South Florida. It is just not happening enough. And I'm seeing a little bit of movement, but we have 90% the way to go, and it's just holding back everything in the economy from small businesses. Small business SBA loans, we waive the fees, 90%. If I was in a bank, I would say, wow, that's a good quality loan. Why aren't banks taking up SBA loans?
That I don't know, and I've been hearing this. I heard this in Las Vegas. I'm actually going to be in Florida in a couple months, and I'm going to be meeting with some bankers because I'm hearing that the small business lending is absolutely key, and it's an area that community banks in particular
We need
are
help.
like the lifeblood for the small businesses. So this has been raised with me. I'm concerned about it. I'm going to be looking into it more. I can only tell you what we've done now, which we've tried to convey flexibility and support for prudent lending to our banks. And if there's more we can do, we want to.
Mr. Dugan?
Well, I would agree with everything Chairman Bear said. I just spent some time with a group of Florida bankers in a meeting earlier this week and heard some of the same issues. And I think first of all, we do not tell bankers to not make particular loans. The banker makes that judgment, and I'm pretty sure it wouldn't shock you to know that sometimes that the regulators get blamed for loans not being made when
I approach my
people
comments, by
are-
the way, more from the borrower's side to
we're in a deep recession. We're in a place, Florida's in a place where there's been a lot of troubles with commercial real estate. I think there has been a risk preferring posture that's gone to risk avoiding, and that's partly due to the economy and to where people are as much as it is due to examination policies. But I quite agree that if the borrower can show ways that they can repay the loan, then that's something that we encourage our people to work with. But the one thing you said that I do have to caution it, time does not always make things better. Sometimes time makes things worse. And we get, as Sheila said, quite criticized, and our resolution costs go up. Our inspectors general fault us for not acting swiftly enough. You'd mentioned the RTC. That was all after the fact, post-closure stuff, where all that stuff ran through it. So it's a complicated balance. We strive hard to do it. We hear you. We will keep at it.
Mr. Bacchus.